Hey, so today I'm still going through my investments, and today we're going through from numbers 10 to 6 with this new expected return. It's a bit of risk adjusted return strategy that I'm implementing at the moment for my investments to see, compare them against each other and see where maybe the best opportunity might lie inside my portfolio. Maybe I deploy more capital into that number one position. But here is number 10 to 6. Oh, and just a quick recap on the previous episode. We had at number 14 was Dropbox, number 13 was Alibaba, number 12 was KPG, number 11 was OTCM. Now, Alibaba's price has actually come down really dramatically since I made that previous video. So maybe it jumps up a few slots, but it's not in the top 5. So Alibaba still sits at number 13 for now. Anyway, it's fine there. Anyway, let's do 10 to 6. So number 10 is Markel, and Tom Gaynor at Markel, I think, is just an extraordinarily great CEO. He's just a great manager of money because he is just really cautious. I really like that conservative approach. Considering my portfolio, I like having this sort of rock solid business in there. They have their main insurance business that it runs really well. They have other businesses in all sorts of niches, and they have this large investment portfolio as well. And I think the chances of this going to zero are like crazy low. Look, not impossible, I guess, but it'd be very hard to believe this is a zero. Now, I think at the current share price around that $1,200 a share, the chances of the business doubling here in the next 5 years, I think, is very likely. See, the underlying business continues to grow and the book value continues to grow. The book value per share continues to grow. So essentially at 10 to 15% book value growth rates, and I think the price is a little bit depressed, all we have to do is the business just needs to just continue on and we'll get a double in 5 years. Now, I think there is a chance of some maybe large multiple expansion happening as well over the next 5 years. Look, I don't think that will happen. It might, but it's unlikely. Markel generally sits somewhere around a 1.5, like a 1.5 price to book, and it's currently at 1.2, I think, maybe a little under 1.2. So it's not going to be a dramatic multiple expansion here. Maybe we see something like a price to book above 2 at some stage. It's possible. But if it gets to 1.5, I think that's probably fair value. Now, Markel is a business in the world. So macro factors that affect every business is going to affect Markel too. They are very diversified, so they're going to be still very rock solid, I think. But general economy downturns, wars, things like that, it's going to obviously affect Markel just like it affects everybody else. But being so diversified, I think it's just rock solid. Essentially, I'm almost sure that they can weather any storm that gets thrown at them, but the share price it's possible that it just stays the same, and in 5 years' time, it's the same. So here on the screen are my thoughts on the likely outcomes. So I think there's a 75% chance of a double. I think there's I was going to say 10% chance of a 3x, but we had to put in a 1% chance of a 0, so let's call it a 9% chance of a 3x and a 1% chance of a 0. And maybe a 15% chance of like macro factors affecting this business. And so the book value doesn't really grow because the investment portfolio shrinks dramatically. The insurance business slows right down because of the macro factors. And there's a chance that happens, but I'm going to call it 15%. So my expected return, factoring in the risks, I think is about a 1.92x from here in 5 years. That's about a 14% compound annual growth rate. That sits very comfortably for me. So number 9 is Skyworks. And this is actually the longest holding in my portfolio. And I have actually learned a lot over the past 4 or 5 years. So would I invest in this today? Probably not. But then I thought I had a good grasp on the tech world. That was probably very naive of me to think, but that's okay. We're all learning and we're all growing. At least 4 or 5 years ago, I was looking at the fundamentals of the business, so it wasn't all just speculation. And Skyworks is actually a really well-run company. And after thinking a lot more about this recently, I think there is just very little chance that this goes to zero. It would have to be something extremely disruptive to come along, but Skyworks is a very innovative company. They have a very good culture. They're across many product lines. I just think a zero is extremely unlikely. If the company just keeps doing what they are doing, keeping the customers they have and continuing working as normal, well, there's a very good chance of a double or probably even a triple from here. But because of the competition in the tech world, I think the upside is rather limited regarding growth, and the risk is a little bit more on here. But at a market cap to free cash flow of just 8, and it's a growing business with this impeccable track record. It's a leader in its field. It's got a rock solid balance sheet. The return on invested capital, return on equity metrics are above 20% for 8 years running now. This is just too cheap for such a good company. And the only reason this isn't in my top 5 is just because the tech world is just a bit unpredictable. So I have been a bit heavier on the expected outcomes for the downside here. Essentially, these are just like unknown unknowns. I don't even know what I don't know, if that makes some sense. Anyway, so I think there's like a 50% chance of a double from here, a 25% chance of a 3x. Maybe I'm being too conservative here, but I've really tried to think about this logically, and I think that feels about right to me, about what I understand about the business. And macro factors, again, like Markel, like all the businesses, could really throw these out, but this is what I think so far. I think there's a 5% chance of a 0. I know I said Markel was a 1% chance of a 0. Skyworks is probably, it's just not as rock solid because it's in the tech space. Therefore, it has to have a higher risk of a 0. And then there's a 20% chance of, say, not much happening over the next 5 years. So the business maybe falters, it slows down maybe a little bit, or the economy slows down dramatically, so growth slows down, and everything just stays status quo for 5 years. Possible, unlikely, but possible. So my expected return, factoring in all of those risks and being quite conservative here, is a 1.95x, which is, again, about a 14% compound annual growth rate. Next up is TerraVest Industries. And this is the most recent investment I've made in my portfolio. And this is a very attractive business for me because it's essentially exactly what I'm looking for in an investment. The best way to sum this up is they're a serial acquirer in a really boring niche. They follow the playbook that I like to see from serial acquirers, the good serial acquirers, and that is decentralized operations, no stock dilution. Actually, they've been buying back shares rather than diluting. Attractive acquisition multiples, so they get a high return on invested capital. They have a great, honest CEO with plenty of skin in the game, and they're spending almost all of their money on new growth areas and acquisitions. The only thing that bothers me out of anything here is, I guess, the debt is pretty high right now after the last couple of acquisitions. So if something really dramatic happens from a macro standpoint very soon, they could get caught into some sort of trouble. But even they just do 1 year's worth of earnings, that earnings to debt like relationship is going to look a lot better in just a year's time because they'll get all that extra earnings. So even though it looks like high debt now, in 1 year's time, it's not going to look like high debt. That's sort of how I'm justifying in my head. Maybe I'm wrong here. There's going to be some risk here in that period of time. So that's what I've had to calculate. But at about 10 times owner's earnings, I think this is a very attractive investment. And to get a double from here, the business just continues on. No multiple expansion needed. Revenue has been flat during the pandemic, but 2022 has come back really strongly. So I'm not concerned there. With 20% earnings per share for a decade now, even if that turns into single-digit growth, plus the stock buybacks that they're doing and a few of their acquisitions, look, a double is just really easy to see. There's lots of different ways for them to get there. But then keeping that 20% earnings per share growth going, and we can get a 3x from here without too much drama too. Maybe some multiple expansion thrown in, and a 4x is possible. That's less likely because everything would have to go smoothly. Now, I have added in a decent chance of a bad scenario here because the business is susceptible to the gas and commodity prices, and plus that higher than normal debt right now, that adds a bit of risk. So here is what I've done for my calculations here. I've got a 40% chance of a double, a 20% chance of a triple, a 10% chance of a 4x. Things have to go smoothly for that 4x, but there's still a chance that happens. I've thought about this a lot, and I thought there's still unknown unknowns here. The gas industry could change very dramatically from political decisions, so I don't think it's very likely. I think it's very unlikely, but let's call it a 15% chance of a 0 and a 15% chance of some bad things happening, but the business still hanging on okay, and maybe it's still a 1x. It just stays the same over the next 5 years. So my expected adjusted returns factoring in that risk is now a 1.95x. Again, about 14% compound annual growth rate, same as Skyworks and Markel. At number 7, we've got Berkshire Hathaway. Like Markel, this is a fortress. Super unlikely to go to a 0 from here, but expecting 25% like per annum here is a bit of a stretch as well. The very likely scenario, I think, is a double, as I think no multiple expansion plus 15% book value growth per annum is just very reasonable to see. Obviously, the track record is there to prove that. That would be my 2x scenario. Berkshire Hathaway has been buying a lot of shares and putting more capital to work lately, like the big purchases of Occidental Petroleum. The buybacks have been the biggest purchase, though. I do think there is a chance of a 3x here. Essentially, it just has to be, things have to go a little bit more smoothly, and maybe the market just sees a bit of, appreciates that buyback situation happening. So 3x is still likely. For things to be flat in 5 years, well, I think that seems quite unlikely, but just overall macro factors, maybe Warren Buffett no longer being in charge, the market might just not be happy about that. It's all hard to know. So this is how I've come up with my outcomes. I've got an 80% chance of a double from here. So very high likelihood that we're going to double our money. A slight chance, a 10% chance of a triple from here. That's sort of the upside scenario. A 1% chance of a zero, like there's fraud or a real unknown, but like if Berkshire Hathaway goes to zero, we have other problems going on in our lives. So I couldn't go any lower than 1%, essentially. So 1%. And there's a 9% chance of it just being the status quo from here. The businesses that they have are really good, solid businesses, shooting off a lot of cash flow with buybacks and good opportunities to invest in things over the next 5 years. It's hard to see it even flatlining from here, but it is possible. It has done that in the past before. If you look over at Berkshire Hathaway's history, there have been periods of 5-year periods where the stock price has done nothing. So we'll say that's likely. We'll say that's not likely, but possible. But even if that does happen, I think the Berkshire Hathaway share price would be really cheap in 5 years' time if that was the case. Because I think the underlying business would have grown, yet if the stock price is still the same in 5 years' time, we should be buying a lot more. I've got an expected return factor in at the moment at a 1.99, so about a 15% compound annual growth rate. If the share price is still the same in 5 years' time, the expected compound annual growth rate from then would be a lot higher. I'm talking well into the 20% range, so we'll just have to wait and see. But right now, I think about 15%. And at number 6, we've got the Prosus Naspers situation. Now, I'm grouping these two together as they are pretty much the same thing. It's just a structural and jurisdiction reason for the two companies, but it's the same management team and essentially the same assets. Now, a bit like Alibaba, where I spoke about in the previous video, although unlikely, there is a chance that things get all messed up here and this goes to zero. Chinese government breaks this thing apart for whatever reason. It is a higher percentage than a non-China related investment. I just think it's very unlikely. And the main asset that Prosus and Naspers I'm referring to here, the main asset they have is Tencent. It just seems very unlikely that this incredibly well-run business is going to zero. A 1x or a 0x outcomes are, I think, just the political risk. If the Chinese government interferes and cripples the Tencent business, then obviously that hurts the investment. Unlikely, but obviously possible. Now, I do think there's a very good chance that this doubles from here. I actually think there's a very good chance it goes further than that, because really the only thing that has to happen is Tencent just continues operating as normal. No multiple expansion needed. Tencent has just great return on invested capital metrics. It's been above 20% for over 15 years now. They've got a very diversified portfolio of investments as well. There's just many avenues for them to expand into. Then the chance that maybe the discount reduces a little bit between the Naspers and Prosus and that underlying Tencent asset, plus possibly some multiple expansion with Tencent, and it's really quite easy to see a triple or a 4x return. Now, maybe I'm being too negative on this because I'm saying that it's the same chance of a 3 or a 4x is the same chance of things going really badly. Look, time will tell. I think that's fair for now because I don't have much insight into what could happen in the future, of course. So saying that it could either go really, really well or really badly, I think is probably fair. So this is how I've calculated it. I've got a 20% chance of a 1x, a 40% chance of a double, a 20% chance of a 3x, a 10% chance of a 4x, and then that 10% chance left of a 0 happening. So my expected return factoring in the risks is a double. So that's a 15% compound annual growth rate over the next 5 years. And there you have it. There's 10 to 6. So I'm using Interactive Brokers, and I think that has a 1% chance of them losing your money. Whereas I think someone like Robinhood, it's more like a 5% chance. And as you can see by the things I've done today in showing these calculations, that does make quite a difference. So there is a link in the description to Interactive Brokers where you can get a demo account and take it for a spin and see how you feel with the platform and how it looks. I think it's very important to have a safe brokerage company. We already take enough risk. That's what I'm trying to do here, is show the risks involved with all my investments. The brokerage account that I use is a risk as well, so we want to get that as low as possible. And in the description, you'll see other interesting things in there, like my Discord group and my e-magazine and things like that. Have a read through the description if you're interested in any of those things. I hope you've enjoyed this video. Next week, we'll do numbers 5 to 1, and I look forward to seeing you then.